Jack, your plant has grown.
It has, and it's like straightened up. I had to turn it around, and now it's freestanding.
That's impressive.
Yeah. I actually got a few comments on people watching the YouTube, and then they're like, yeah, nice fiddle.
Were they referring to the plant or?
Well, good morning. We've started well. How are we all?
Great.
Cold by the sounds of it down there.
Yes.
You two with your blankets.
We're getting a lot of rain up here.
Well, of course we are, Don. You have a wedding this weekend.
And because we started digging all the holes for the extension, it's been dry for how long? 6 months?
Yeah.
As soon as I dig a hole and clean it out, ready for the engineer, big storm comes through. Right, we've got to find someone to dig the holes out again. We do that. It rains again, fills the holes. It's like, it's from the castle, but it's no longer funny.
I think it's funny.
I'm more worried about the neighbours at 3 a.m. because my sister's 8 years younger than me, and so they've got an energy this neighbourhood hasn't experienced for a while.
Just invite them.
Just go drop a bottle of wine off before it starts. Hey, just in preparation.
Yeah. Apologies in advance.
Yeah.
What have you been up to, Aaron?
Getting the house emptied in Cairns and getting mum sorted. She goes in for surgery this morning. Actually, she'd be in surgery right now. So bit of a big day to see how she goes with that. But that's it. And then Squizify. It's been all about the deal.
Yeah, ditto. Squizify. And long weekend this weekend. So that's exciting.
Oh, is it?
Oh, is it?
Well, it isn't SA.
Who are we celebrating?
No idea. My calendar's blocked on Monday, so I'm like, okay.
It is too. Public holiday. Look at that.
And see, we're on top of the world.
Is it wrong that I get excited about a day where there's going to be no calls that I can just work?
My partner wants me to go to golf with him for the first time. So.
Oh, how fancy.
Yeah. Well, I suggested maybe pickleball, but...
How long have you been together?
Almost 2 years.
We're at the golf stage. Right. Interesting.
Golf stage.
He's proposed it earlier and I ignored, but continues to pop up. Feels like it's not like I have to at least try to tell him I hate.
I like that you're still at that phase where you're willing to do things you don't want to do. Oh, to be young again. And Jack, you haven't moved in yet.
No, not yet. We've got about a month, a bit over a month. So 18th of November.
Wow, that's going to come around fast.
Yeah. Yeah. So there'll be a bit of work to do between now and then, like, because we've got to move out of our rental and then shift across. And there's a bit of work we want to do in the house before we get in there. So
coming on the US mission would be perfectly timed for you to get out of that?
Yeah, look, Anna has no idea about the US mission yet. So if we get enough for me to come, I'll break it through then.
All right. Well, let's get into it. So just a bit of a recap from last week's episode. Last week we talked about Scalare Partners' backdoor IPO on the ASX. A follow-up article came out by Bronwyn Clune saying venture capital is broken. Scalare pitches backdoor IPO as VCs question the model. And so we had raised some questions last episode on the areas that we had some questions around. Bronwyn wrote this article. Interestingly, everyone interviewed was anonymous. Nobody wants to actually stand by their questions, and journalists don't seem to be able to find people that are willing to stand by what they say. But the article says Scalare Partners' ambitious plan to open up tech deals to a broader set of investors via the backdoor IPO has been privately questioned by venture capital investors. Scalare is set to enter the ASX through a reverse listing of defunct confectionery company, becoming Australia's first publicly listed early-stage tech accelerator. It plans to raise between 4 and 8 million. Now, the CEO says, I think people don't have the opportunity to invest in early tech and access it via the VC model because there are barriers to investing, and it locks away your money for 5 to 10 years until there are liquidity events. We want to break the mold. We think it's outdated for tech scale-ups and startups, and we want to make it accessible and available to all sorts of investors like retail investors. Scalare has already invested in 27 companies across 6 countries with a current portfolio valued at 10.23 million. And as we discussed in last week's episode, that 10.23 million, a lot of it seems to be just internally valued by them. However, the company's financial performance raises questions for one hoping to list on the public markets. Scalare recorded a pro forma after-tax loss of $350,000 in FY24. On paper, Scalare's ambitions seem noble, giving everyday Australians the chance to invest in innovative tech deals, typically reserved for sophisticated investors, but leaders in Australian VC may remain unconvinced. Several VCs spoke on the condition of anonymity because they had concerns about the uniqueness and the expertise of Scalare's support services, the clarity of its investment proposition, and the suitability of public structure for managing early-stage investments. I think a lot of that echoes some of the things that we discussed last week, although we also looked at their valuation process and raised some questions around that. Just one final bit of the article says that similar listings have proven difficult. Touch Ventures, an investment holding company debuted on the ASX in 2021, focusing on high growth opportunities in areas like retail innovation, consumer finance and data. And I think Touch Ventures, if we just have a look at that, yeah, it looks like opened at 47 cents and now you can buy it for 6.8 cents.
Yeah, wow.
Where do we want to start?
Well, I think maybe we start by saying we're happy to state our opinion and put our name to it. But no, look, it's a noble cause what they're trying to do. It is worth pointing out that there are equity crowdfunding platforms already trying to open this asset class to retail investors as well. Like we said last week, that the public structure and the disclosure requirements around that is, I think, a risky approach. It's definitely something I wouldn't, it's hard enough, this game, right? And I think it just adds another level of complexity and risk. And outside of a public listing, we saw it with Breakthrough Victoria, with government funding going into this space and the calls for accountability and transparency and more reporting in a world that is information asymmetric. So I don't know. I think they're setting themselves up for a potential failure.
Yeah, I echo that as well, Aaron, particularly the disclosure side. I think there's a approach to providing investors with additional transparency than other VCs. And I think that's definitely something that we at Tribe pride ourselves on. But to have it be regulated and a different structure, it's not a game I'd want to play in.
But I think I try and separate a little bit. If you want to have a publicly listed fund that holds private assets, okay, I can't think of many examples that have done that successfully, and there's just a river of fuck-ups. But okay, no problem. But part of the challenge here is that this is a consulting company, the way I see it, that's holding some private assets. And one of the sayings that we constantly give to our portfolio companies is, if you confuse, you lose. Like, I think part of the issue is that it's going to become a more and more confusing value proposition and confusing to understand what it is. Now, this article's messaging is we want to give retail investors access to VC investments because the model is broken. And again, I understand that. And in some conversations I had this week, somebody, like, being sophisticated in terms of the money in your bank actually does not make you sophisticated in terms of investing in this class. There are people that don't meet the threshold that absolutely would leave a billionaire for dead in this space. And so I do absolutely agree that for a range of people, it is unfair not being able to invest in this asset class. But at the same time, it's risky as hell. Like, it just, the stats are the stats. 8 out of 10 things just disappear into the never. So here, though, it's actually a consulting company, really, because when you have a look at their portfolio breakup, they put the amount of cash invested, but then equity earned, and then they get paid for directorships and all sorts of other bits and pieces in cash. And that's one of the things for me that investors are going to need to get their head around. And so holding themselves out as this is a way to get access to VC deals is not actually, in my opinion, true, because part of their business isn't actually going to come from the returns of the portfolio. If you have a look at, they're going to raise between 4 to 8 million. I've got the prospectus, a screenshot from the prospectus here for the YouTube watchers. But if they only raise the minimum, the 4 million, 1.6 million of that is going into investments in existing and new portfolio companies. If they raise the maximum, the 8 million, 2.4 million is going in. Like nearly 4 million is going to go into working capital, 500,000 into tech development. Now, I'm sure they'll say, well, they also earn equity and what have you. But as long as we understand that the majority of the funds that are being raised here are not going into VC investments. And then with the services they do provide, without wanting to labor the point too much, they're going to be targeting companies that can make their model work. And the companies that make their model work are the ones that are going to be willing to accept all the stuff they do. And I have a belief that when we try and add value to the portfolio should be choosing who they want to add value. And for certain things, we can add some value, and for certain things, we can't. But if we pigeonhole founders where they can't go out to market and find the best person or the best company to help them with a certain thing, I think there's a problematic level of conflict there, holding out to say, well, we're the answer for all of these things. Like I just see that fail time and time again.
100%. That misalignment that's going to cause conflict between identifying a company that might be a perfect fit for their service offering and build their revenues and contribute towards working capital requirements versus that which is going to make a great investment but might not be a fit for their services. Like immediately you've got conflict between those two. And Don, pulling that information out of the prospectus, like the fact that on an 8 mil raise, if you take out what their setup costs are around infrastructure pieces, like they've got a 1.5 times working capital to investment capital. Like that's incredibly inefficient as an investment firm, if they were solely an investment firm, where C is typically 2% management fee, right? So, but then I think that's the key point, is that they're not a VC. Really, that's ultimately what this is. They're a service provider.
Well, happy for disagreement. Well, actually, Adrian Bunter messaged in, which I shared, and because we had posed the question, what percentage of backdoor listings are actually successful over the long term? And I guess I have a theory, but his view, and he plays a lot in this space, was that it's more to do with the business than the backdoor listing. And I can get behind that. But because the criteria and ability to become backdoor listed is less than a full-fledged IPO, I think it does attract weaker businesses with weaker business models. And if I was a betting person, I'd say that the failure rates of backdoors is higher. But like most things I say on this podcast, I have nothing to substantiate that. I have nothing to back it up. And listener beware in terms of what you listen to.
We do need a disclosure at the start of our podcast. But it was a good point. Like, yes, it comes down to the business and the quality of business, absolutely. But I agree with you.
And Adrian pointed out Fortescue backdoor.
Yeah.
Chemist Warehouse is about to backdoor. There's been some big ass backdoor, but I have a feeling all the value resides in a really small percentage.
It would be good to see actual data. Yeah. I do wonder the same thing. Does the type of business that selects it change? Anyway.
Jack?
I've got nothing to add there, Don. That was a good number.
And just on like the VC game is sourcing, that's seeing deals. I saw you added some good stuff there, Aaron. So it's sourcing, you got to see the deals. Choosing, you got to select the deals. Closing the deals, you've actually got to win the bloody things, which it can be a bit of a fight for really good deals. You've got to support the deals, which is nurturing them, and then you've got to exit them. You've got to realize. And so if you're somebody considering investing in early stage, you've got to analyze, is this company going to be best placed to source, choose, close, support, exit? And have they demonstrated an ability to do that? If you're not seeing the best deals, there's a problem. And even if you are, if your criteria for selecting takes you to a different path, it's going to be a problem. And if supporting them creates some challenges, anyway, like that's investors need to be unpacking and understanding what is the edge that this company has. Now, also to recap on something that we discussed prior was Ed Keelan from Octopus. We discussed blogs number 1 and blogs number 2 in losing product market fit, and he released blog number 3. And in a post, he said, losing product market fit, the Canada problem. Just interesting that he would attack an entire country. So
I like how you frame that for Ed, like it was him with that statement.
Look, you make fun of our pictures and our frameworks and our concentric circles of success. I'm going to come at you. No, inside joke between us and Ed. So he says, losing product market fit happens when scale-ups start to get traction, perhaps in the 2 to 10 million revenue, but external forces start pulling the company away from its mission and destroying product market fit. If this is the first time you're hearing that, I'll put the link in for the other two blogs because he unpacks that really well. But he then goes on to talk about the best anecdote he's found over the past few months is from Mark Randolph, Netflix founder, who calls it the Canada problem. So it wasn't Ed attacking the Canadians, it was actually Mark. It goes on to say that as Netflix were growing, they had the chance to move into Canada, something that would grow revenues 10%. They decided not to. This new geography would have become a distraction. There would have been new languages, new regulations, new operational requirements. All of this would soak up a load of time and focus. So Netflix leadership decided their time would be better spent on their core proposition, which at the time was DVDs. Every time something came along that wasn't subscription DVDs, they would go on to focus. And the post just continues to talk about that. And we just see it all the time. And I don't see it a country like expansion geographically being the major problem. It's actually expanding into other verticals, other markets who then want new features, new functions, or whatever else.
Yeah. So from my perspective, I agree with you, Don, where the vertical is quite often the distraction. But I will say from a geographic standpoint, I do think there is distraction, particularly when it's a founder looking to make their first one or two plays externally of their originating country, where they may have one client in Japan, one client in Thailand, or one client in the US, and then they're like, oh, we must do all three at once because they've got one client in each of those, instead of actually thinking about the broader go-to-market strategy for international expansion, because they want to go where the market is pulling them, which is right. But at the end of the day, you don't necessarily want to take on 3 new markets at once. You want to take on the one which has the broader expansion plan and the ability to have a bigger impact on your revenue. Canada, yes, big market, but big distraction. Also, if you haven't already nailed the US market.
Yeah, I think, to add to that as well, like we're forgetting the issue here is TAM. And if we're talking about the US market, it's a 300 million person market. Why would you focus on Canada when you haven't even maxed the American market, which is your primary one? And like, it's much easier to put all your resources into one market, solving the one problem. And then when you reach that TAM there, then expand.
And we were talking about the entrepreneurial impulses on message yesterday with somebody in the Australian ecosystem that built a big business, got into trouble, spent a lot of time licking their wounds, and they've, on the face of it, got and done the same thing again, built a really big business really quickly, stress and strain has started, and the question one of you posed was like, oh, I thought you'd learn a lesson. But the problem is with underlying instinctual processes that were probably formed when mum or dad yelled at you too much when you were 3, they're hard to shake.
Totally hard to shake. I always love these posts from Ed, and they remind me of something Pat Grody from Sequoia said, which was fewer, better things. And he was talking about the pattern he's seen across the Sequoia portfolio of when founders start talking about new products, new markets, new this, new that. And it's like if they just actually focus on doing what they're currently doing better, that typically leads to a better outcome. And so I think, what you all said around focus on capturing the market you're in, focus on enhancing the customer experience or building more retention and referrals, like that, those key elements, the fundamentals. And to Ed's post there, like that second point around what to do if you've lost product market fit, like simplify.
Well, this is the thing. He actually is prescriptive of what to do. I'm very disappointed that this doesn't come with a chart. There's 3 S's. This could have been the 3 circles of stop, simplify, survive. He says stop. And I think like that is such a big thing for entrepreneurs, because they're so often on the rat wheel that the idea of stopping just freaks them out. But actually, what's the saying? If you're digging yourself a hole, stop digging. Like that's step number one. And he says, if you've lost product market fit, you can't sell your way out of trouble. It's like that old adage is like, they lose on every sale, but they're going to make up for it in volume. Like it's just, fuck, stop, would you? Then simplify, focus on what you do well and do more of it to your point, and then survive, protect cash at all costs. And so often we see founders using hope as a risk management strategy, hoping that it's going to change and turn around, and they end up blowing cash on things that were just a waste because they were unable to find the strength to make the hard decisions.
It is hard to turn this off for entrepreneurs, right? Like I think, for conversations you've been having this week, Don, in the family office, and yeah, even last night visiting my mum in hospital, like with everything she's facing at the moment, she starts pitching me a business she's seen for sale, and she starts talking about buying this pub in a regional town. I'm like, I actually had this exact conversation. Stop, simplify, survive.
We need you to get through the surgery, please, Mum.
Yeah, just focus on this first. Simplify your life. But you just can't turn that off. It's in their DNA.
And nor would we want to. Well, we've also got to understand that there is no entrepreneurship without some of those impulses. And we ourselves have a look at Tribe's journey and how we've fallen foul of all of the things that we speak. So make no mistake, I guess the only reason we talk about these things often with a bit of passion is because they're the same things we fuck up. But as an investor, you get to at least look at others and make comment.
Oh, it's so true.
I would add on the survive piece. Quite often, because entrepreneurs haven't stopped, they find protecting cash to be extremely difficult. Whereas if you can actually stop and take a moment to simplify, then the survive becomes easier. Whereas if you're trying to cut costs while running, that's where I've seen it blow up.
Yeah, and there's certain, like if your cash runway is getting low and you're stress and strain and you're still organizing meetings with people through an executive assistant, like they're the kinds of things that bit of a problem. And one little thing that I've often thought with product market fit, because there's this implied assumption product market fit can be good, and by being good, it means that you'll be growing and successful. But I do have a view that actually a lot of companies do have product market fit. You've just managed to find a shit market. Your product fits the market. It's just shit. You have fit, but you fit to shit. And so it's not actually about if you keep trying to flog yourself, oh, I'm going to find product market fit, find product market fit. Well, sometimes you've actually found it and it's terrible and you've got to move somewhere else.
That's a good point, Don. It's probably worth talking about what that can look like. Like it's not just necessarily a small TAM, like a small market. It might be a super low margin market, right?
Low margin, like sales cycle. There's nothing you can do to get the sales cycle under 2 years. Actually, customers just don't care as much as you do. You can't get rid of inertia and apathy. There's lots of alternatives. It's just shit. Now, you're passionate about it, but if you keep flogging yourself, actually, you're not going to achieve what some of these other companies are able to achieve because their market part of product market fit has just much easier attributes.
And really, when you think about product market fit, it's just gross demand. So even though you might have a product that is suited for the market, if there's no demand for the product, you don't have product market fit. And like the analogy that Mark Andreessen gives is like when the phone doesn't stop ringing, you can always look back in hindsight and like that is product market fit. But really what that is just gross demand for the product.
Yeah, I'd extend on to that. You could have product market fit and still not have a great business.
Yeah, 100%. The unit economics might not line up. Like there are all these other factors, but product market fit is gross demand. Like it's just, there is so much demand that is being pulled from the market for your product.
It's difficult. And I think it was in last week's episode or maybe the episode before, when do you know to give up? Hard. I know a lot of people that gave up too soon. I'm on the portfolio with a couple that like, I think they'll get there, but they wish they gave up a decade ago. But like with a little bit more fine tuning, a little bit of changing, things actually take a lot longer. I think they'll get there. And then some, it's just like, there's just no evidence here that this combination of ingredients, this hand you've been dealt, has the ingredients required to achieve the outcome you're trying to achieve. And this morning, I was with a US company before a session tomorrow in the family office, and the problem there is They started 8 years ago when there was like 2 competitors. There's now 15 well-capitalized competitors, and there's been a whole series of things where they've fallen behind, and I'm trying to be supportive and trying to give some energy, but it's a different world if you've got 15 competitors that all look and smell and do the same thing. Now, the founders find it hard, investors find it hard, but every now and then you do get a return, but some environments seem to produce returns more frequently and of higher quantum than others. And in the AFR, there was an article talking about how Startmate, so Cannon-Brookes Startmate cybersecurity bet pays dividends, where the 35% stake in cybersecurity company BugCrowd is now worth 2.1 million, delivering eye-popping returns. And Michael Batko did a post saying 9 out of 10 times VC loses money, but when it works, it really works. How 35,000 turns into 2.1 million. He said, at Startmate, we raise and invest 6 million every year, currently backing 30 out of 1,200 companies that apply, so top 2%. 13 years later, the funds have world-class returns. 4 are in the top 5%, 9 are in the top 25%. How? They believe in our founders all the way from beginning and forever after. BugCrowd is a great example. So that's a great result for Startmate and the ecosystem.
Yeah, and that's in 11 years they turned that BugCrowd investment from 35K into 2.1. Not a bad little returner.
And Rain Ong, got it right, said credit to MVP Startmate mentor Alan Jones, who actually convinced Casey Ellis to join the program over Alexa. So there's some very specific detail, but that's the way the Startmate program works. And I think most funds work. It's partly the connections and the relationships that are doing introductions, and this one seems to have paid great dividends.
Yeah, it's a great outcome for the ecosystem. I was very impressed.
Now, the link here is there was another article that's come out that, again, Cannon-Brookes-backed millennial super fund Spaceship snapped up by eToro in an $80 merger. $80.
I wish.
We've got inflation, but it hasn't gotten that bad. $80 million merger. It says global trading platform eToro is getting into the Australian superannuation business by acquiring the controversy-plagued investment app Spaceship Capital and deal worth $80 million. The price is a blow to investors such as Airtree, which previously valued the fintech at more than $100 million. And I think at the peak it was valued at $170 million. What's interesting with this one, it's all shares. It doesn't look like there's any cash. These are the kinds of transactions and M&A deals that tend to happen if something isn't a rocket ship. Sometimes you're better off just attaching it to somebody else's ship so they can get escape velocity.
Well pun.
See how I brought all that together? It's just amazing. I'll be here all week.
You were up from 3 a.m. writing that?
Andrew Moore, who took over CEO in 2019, said the M&A deal was pivotal moment to Spaceship. We're deeply aligned with eToro's goal of making investing accessible to everyone. I think we're going to see more and more of this, M&A trying to push things into environments to achieve results that they themselves haven't been able to achieve.
Looping back to the Scalare listing, that the launch of this, I remember it really well. Like I was in that peak hype ecosystem era, like 2017, and Spaceship was, the marketing was opening up this asset class to retail investors and mum and dads to put their super into early stage tech companies. And there was so much market noise about it, and they just quickly vanished. It was a flood of people sign up, and then just heard nothing. And I actually signed up. I went through the onboarding process, and then I can't remember what it was. There was something about it where I got into it. I didn't like it for whatever reason, but it just then went very quiet other than all the ASIC issues and controversy. So when I saw this headline, I was like, wow, only 80 million. And I looked up, it seems at their peak, they had 1.7 bill in funds under management. And by mid-22 it was 1.3 bill. So interesting one. I'm a bit sad it didn't live up to the hype. I liked what they were pitching.
You don't like that it seems to have flamed out a bit?
Yes.
Yeah, no, I just couldn't reach terminal velocity. Jack, Ash?
I just love to see that Canon Brooks. Like, man, he's done a lot for the ecosystem.
Yeah, the AFR likes to smash the shit out of him, but there is so much in Australia between him and Farquhar that would be so different in our ecosystem if they hadn't done what they did or do continue to do.
It's such a good point, like that 80-20 rule of everything. Like there's a handful of people, and going back to the comment about Alan Jones making that connection for the founder into Startmate, there's certain people who just touch and add so much value, and Atlassian, that ripple effect of their success is just phenomenal for the ecosystem.
Now that dovetails quite well into another article and a few posts that we saw during the week, and this was in Capital Brief by Bronwyn Clune again, saying VCs line up M&A for low-hanging fruit in a major shift on exits. Australian venture capital firms such as Investable have grown far more open to M&A among their portfolio companies as they look to boost a key measure of returns. And so this talks about, and when I saw this article, Jaden Basher, one of the investors at Investable, says that it's been a busy past 18 months at Investable with 9 exits generating 33 million in exit value across our funds and club Investable. That's a bloody great result.
Yeah, bloody great. And it's not clear, were these acquisitions or secondaries included in that?
Good questions. So Capital Brief spoke to several funds who are relying on M&A to boost their distributed to paid-in capital, DPI, a key metric measuring the ratio of cash return to investors relative to the capital invested. Exits are number one priority for us, said Charlie Ill, the CEO of Investable. That's one of the things we're doing is having a hard look at the fund, and we're looking at what's low-hanging fruit. It's paramount that we are returning capital to investors. Otherwise, everything's just paper. Now, they've been going things since 2014, so there's 10 years in. We're 3 years in, so we're a little bit behind.
Yeah, it's interesting. So they've been going since 2014, have 180 mil under management, and these 9 exits happened over the last 18 months for 33 mil net return. Sharing news with our investor base of our first exit and return of capital to investors. And like I told you guys, I found that stat from Carter that 9% of funds of the 2021 vintage have returned capital within their first 3 years. And on one hand, you might look at that and go, great, Tribe's in the top 9%. But what keeps me awake at night is the fact that returning capital early means you're not getting the value of the later uptick. And so there's always that challenge with returning capital. Yes, it's great to create liquidity. Yes, it's great to get a win. But man, if we hold longer, what's the overall return we could have achieved?
Totally. But we backed the founders.
Yeah.
They wanted to exit, so we exited.
100%. Like it's not a decision question. But it is interesting for me that what came through in the quotes here from Charlie Ill, like a definite sentiment of looking for liquidity events right now and wanting to return capital to investors.
Jack or Ash?
Yeah, nothing to add there, Don.
Yeah, and I think it's a key part of the investor role is at least asking that question and driving it forward. Now, the companies that exit are the ones that not only have achieved product market fit, have been able to sustain a good business, but pure play SaaS, we've been discussing a number of times on this podcast. There's just a lot of sentiment coming out, and we share it as well, that the era of SaaS has definitely changed. If not, it's over. And there's a post by Michael Jackson says the SaaS era is over. Software is a business tool, not a business model, which was a quote by Sam Lesson. And what Michael does is he posts a conversation or somebody else's post around how SaaS is dead. It says, people have figured out that the dream of the beautiful business model is just that, a dream. LTVs are far from infinite. You don't acquire a customer onto your SaaS platform once and they pay you forever. There's continuous pricing and competitive pressure. 2, software is getting more and more commoditized. Hello, AI. As it gets easier and easier to roll out your own software, build replacements to SaaS, guess what? Software gets less and less valuable. Code depreciates. Then number 3, SaaS is hard to sell well. The PLG story doesn't work forever. And even if you have a massively margin expanding story on how great your software is, unless there is a clear line item, it's hard to sell. And even when you do sell it, guess what? You don't get paid that much frequently as a percentage of the value created. We're certainly seeing it with our investment thesis. If you're just a pure play SaaS, the world is just so different to a decade ago.
When you look at like exceptional SaaS companies, like look at Canva, for example, lifetime value. We've got whole industries that rely on this software 100% to then provide a service. So they're not going anywhere because they don't have the Adobe skills. They're fully reliant on the Canva skills. And then we look at like, it's getting more commoditized. Hello AI. Like AI is only supercharging Canva's functionality. So it's just becoming even more useful for the user that is reliant on that. And Bloomberg's another example. Like there are so many examples where there's actually defensibility and those 3 points don't hold true. Especially like SaaS is hard to sell. Like you listen to Safety Culture's product-led growth, like their story. Like, I don't know.
But would it be fair to say, Jack, though, I think what we're talking about is the new crop. If you've got incumbency, I think everything you say there is absolutely true. And AI is helping Canva get defensibility. But in some of these emerging segments where there's already multiple providers and we're already starting to get commoditized, it's just a different world to when Canva, Safety Culture, all those companies started, isn't it?
Yeah, but I still think like you look at Squizify, like you still find a market that isn't got 16 competitors and the dynamics of the market will allow some type of defensibility. Like these three things don't hold true because it's a product someone wants, so it's going to sell very well. And then there's actual defensibility there. So therefore, the lifetime value is going to maintain and it won't get commoditized.
I agree that I think the nuance with Squizify is the fact that it has an IoT, like it's not a pure play SaaS.
Yeah.
Like
Yeah, I still think there's going to be markets where if there's a defensibility on a pure play SaaS, it's going to hold true. And the only reason, I still think that holds true because the only reason it wouldn't is if it's been already commoditized.
Yeah.
So what are these markets, Jack? I want a list.
Yeah,
and I want the companies we're going to invest in.
Well, no, like for example, I can name one, Comtrack, like pure play software. It's going to be defensible because once these big organizations get used to running it, there's a massive switching cost because you're going to do all your investigation from start to finish on it. Why retrain someone how to use that when the whole police force knows that? That's a pure play SaaS.
Oh, totally. I think there's still so I see what you're saying. Yeah, the ability to build in a durable advantage, absolutely. And I think your point about AI, Jack, like for me, I've been thinking about this around, I think Sam Altman made a comment about how to assess the risk of OpenAI to your venture. And the question he would ask is, does the advances in their model and the advances in AI actually add value to your offering, or does it actually threaten your offering? And I think looking at Canva, like the advances to me add value to their model. But yeah, I think you're right. Like, do you think, Jack, though, it's industry specific, or do you think it's just the company's ability to build like a competitive advantage that's durable?
Well, I think the market's got to enable defensibility. Otherwise, none of those three things hold true. Like lifetime value is going to be fucked. So going to won't hold true. And either will, like it being hard to sell. That's just when you look at a market and if it enables that, like then you should double down on that market because it's one you want to compete in.
Yeah, the contract example being public sector, I think there's a natural, like winning that sector, like doing the land grab, winning that, they're pretty sticky customers. So as an industry, I see what you're saying.
Yeah, particularly industries where you have to be on a panel to be selected. Like whenever there's an additional barriers to entry, I think that also really helps. But the example that I feel does fit this mold is like CRMs. Unless you are rapidly integrating and you're building your product to be more useful with AI, I hate most CRM systems. They never do what I actually want them to do. So I could see where that is a good example of this.
Ash, I picked up on your hatred for CRMs when day one we've shifted back to Google Sheets.
Yeah, it didn't take long. I was like, nope, doesn't have what I want. Get it out.
But like even the CRM market's quite interesting because there's multiple players that are winning, but HubSpot's still growing at a crazy rate. So is Monday. Like they're like exceptional businesses. And look at Entreport. Like we're not going anywhere right now, and we're paying $300 a seat for 4 people.
I think there's a whole episode in CRMs.
Yeah, because a lot of digging.
What sort of comes up for me is the Charlie Munger airlines versus cereals. And this post is like an airlines type industry post. Mm-hmm. It's all the problems that airline industries. And then a lot of the examples we're citing are cereal type companies that have been able to maintain margins. But it is true that they're in a whole lot of these verticals and a whole lot of new SaaS, they're getting smashed.
Yeah, I think the nuance is done. Like, if you believe that the market, the dynamics are healthy and it will enable a competitive advantage, then you still want to go into it. But if you don't believe, like, this is just a nice to have tool that people can make themselves, like, there's no defensibility, why would you ever want to go down that? And previously, what the defensibility was the time it took to build the code. But now that that's being disrupted from AI, why would you bother? But if there's like an actual defensibility, not just the time to build the code, then you still want to double down on it.
But with the switching cost defensibility, which I agree with, switching costs come when you've been able to get the sale. And what a lot of companies are finding challenging is getting the demand generation and sales processes in a really noisy market, hubbing enough to get enough scale of customers to even have defensibility. Once you've got defensibility is defensibility. Where people are struggling in a really noisy market is that front end bit.
Yeah, no, I agree. But like, I don't want to invest in a company that's got 16 competitors in a really noisy market. Like, we want to get into it. You know what I mean? That goes back to the dynamics of the market. And then we look at product market fit. Is there gross demand for your product? If there is, can we build in a defensibility? Like, that's the second element. And then is the TAM going to be big enough that we can see a venture return? Like, there's levels to it. But when you think about this post, like, I don't know. I think it's like, it's not going anywhere. SaaS is still going to be around. And there's always going to be pockets around globally that you can double down on and build a really good business.
I think, Jack, you're also concentrating on those verticals and markets where they don't already have SaaS at their fingertips. They're the unsexy markets that have been the last to adapt tech. We as a business are trying to find those founders who are going after those markets that are still relying on pen and paper, who haven't been disrupted yet. So that's also part of our thesis of like why this may not line up with those and why we still think those are great investment opportunities. But for me, these businesses that are in the more sexy verticals that have already been disrupted by tech, that's where I think unless you have a lot of market share, to Don's point, it's hard and margins will just continue to deteriorate.
Yeah.
I think everyone's right. We're just all coming at it from different angles.
Yeah, and I think actually, Don, help me get clarity. Like, I think it's a question of early stage trying to create high switching costs and some sort of durability versus those that have it. And it is, it is why we focus a lot on that durability piece. So I guess for founders to double down on what makes them sticky, what gives them the structural competitive advantage long term.
And Aaron, that sort of segues a little bit into something you found, which is SaaS growth is cooling, but free trials are converting at double the rate to freemium models.
Yeah, so this came from OpenView Ventures. They produced a report benchmarking mostly like PLG. So the topic was around looking at companies, 1,000 companies, and comparing different models for product-led growth. And so a couple of the key highlights that came out of this one, main finding was SaaS growth overall is declining, which we've heard from a number of data sets. Only 1/5 of companies are now growing at least 75% year on year. But the top tier PLG companies, so those that are like top quartile PLG led, they're growing at twice the rate of traditional SaaS companies. But then what was interesting, like for me, was the conversion rates between freemium versus free trial. So free trials that then end and force you into a paid contract have double the conversion of a freemium model where you can stay on the free tier without having to convert to paid. And so the other key one out of this report as well for me was them saying that PLG now requires you to do more than just, like, you've got to have an active sales process as part of it. And what they referred to were that the most successful PLG companies are boosting conversion rates with very targeted outreach based on user signals, which intuitively makes all the sense in the world. But I think for founders, like one thing I hear a lot from early stage founders is, we're going to have a PLG strategy and almost speak of it like it's a set and forget. We put it in the app store, it'll drive itself. The data is showing that pure PLG strategy is just not working. It needs to be augmented with a really strong touch point and sales, like more conversion strategy, conversion activity.
Yeah, this is a great find, Aaron. I am a huge believer of a free trial versus a freemium model. In a past life working on a SaaS product, I was all for the the free trial, because I think particularly in the world we live in today, it's the little bits of paprika or the extra bit of like sass that when you have the full version, that's what makes people sticky versus a freemium where you don't have the full red carpet per se. And I think by actually getting the red carpet, that's where you feel why you want to keep that product versus only having a subset of that interaction. So for me, this is 100% true to how I buy products, but also how I've thought about it previously. And I think we, as founders, you need to have more than just a PLG strategy on top of that as well.
And I think, and to add to that as well, there was that graph we found that was saying like the product-led growth companies, and it's like the evolution. And you may start PLG, but as you expand and reach the top of that TAM, you've got to go up the chain. And you look at Canva, like they've done exceptionally well for the past 5 to 10 years, and now they're moving and shifting up to maintain the growth rate. So really, like if you want to maintain the growth rate, you either have to go up the chain or down the chain or introduce new products. Something that we like quite often say, like it's just an easier strategy to execute solving one problem for one person in one market. Like just do that first, earn the right. And once you've earned the right, then it's time to expand to a new customer or expand to a different market. Like just do things in sequence and earn the right.
And if truly, if your market and value proposition means that you have to simultaneously do 5 things at once, otherwise somebody else is going to eat all your lunch and you have no opportunity, from an investment perspective, that's a shit business. I think it's somewhat related to what we're talking about, because whether it's PLG or enterprise or whatever else, you have to take people that are unaware that you exist to being aware that you exist. And on that demand side, and I just found this little video post, and I thought there were just some really helpful little bits in here. So I'm just going to share my screen, share audio. And this post is by Magic Breif.
Here's how to do an audit in under 5 minutes to answer these key questions about your competitors. Firstly, what formats are they testing? I would take a big scroll through their ad library and look at their split between videos, images, and carousels. It's also worth taking a deeper dive and looking at if they're testing UGC or high production content, if they're really leaning into us versus them or doing a lot of founder content. So you can start to get an idea of what formats this brand is going after. You can see what messaging they're going after by looking at their hooks, ad copy, and headlines. The cool thing about this is you can see how their messaging changes throughout the year. So for example, here in AG1, you can see that around the New Year period, they're really going after this habitual routine, new year, new me messaging. And then as it moves into winter, it becomes more around like immunity and upkeep with your health. Products they are launching, this is going to come down to you looking at their landings. Usually brands will have a set of their core best sellers that they're going to drive most of their traffic to, but particularly if they want to push traffic to a new launch, you can see what this is by looking at the landing pages that they've tested most recently. Next is what sales moments they're going after. And you can do this by mapping their creative velocity against different sales moments throughout the year. So here you can see that AG1 actually reduces their ad spend in this time where CPMs are infamously very high because everyone is fighting for those holiday sales. And then they ramp back up for the new year, and they would get more bang for their buck spending there where it's a little bit cheaper than fighting for people's eyeballs and wallets when everyone's shopping for Christmas. And lastly, but super importantly, what is working? This one's pretty easy. Just sort their ads by runtime, and generally if an ad has run for longer than 30 days, you can assume that that is a top performer for this brand if they're a brand that regularly checks the performance of their ads. Hope you found this helpful, and follow us for more tips.
I just thought that was interesting for a couple of reasons. Some people may not be as au fait with that whole digital marketing world as others, but it's founders and their teams that are doing this kind of work that are going to float to the top in an environment that's really hard to find leads.
Completely agree. She laid it out well. Simple. She'd be doing this regularly. Do not get on it.
And it's the kind of, like, as time progresses, people's content has to become more and more helpful to stand out. Like there's no way 3 years ago that there would have been that level sharing as a top of funnel marketing exercise. But in order to stand out, you've got to add more and more value here. That's the kind of thing that an agency tries to charge you a whole lot. Here's somebody that's just laid it out for you. And that's what we're seeing. There's this constant march of how do I add value and find people in a very noisy market.
Yeah. I love that the post was about that while also doing that, like as in adding value, demonstrating value, for what is I assume they're an agency. It's a platform.
Yeah, so they're actually ex-Eucalyptus backed by Blackbird. So it's the ex-head of creative at Eucalyptus jumped out, and it's pretty much just a tool for creative teams.
Sweet.
Pity we're not creative. It was good. It just got me reminded and thinking. So I'll put the link to that. Well, that's the show. Shall we get to some Sharts?
Shot time.
This is a pretty random. I've had a bit of a big week this week, so I've had to pull some inspo from different places. So I saw this from Stefan Zoflu, who's COO at Equity Crowdfunding. It's got this really ripped squirrel with big muscles. And it's like founders in Q4, and then the investors in Q4 are just bears lying on the floor doing nothing. It's not far off. There's some really good companies with really good founders that just can't get the attention of investors at the moment. This I whipped up in the middle of a meeting the other day. It's a king facing out towards a battle holding a sword, and two of his men are trying to get him to look at someone's new invention. And he says, "We don't have time to look at things. We're too busy fighting a war here." But the thing that they're trying to get him to look at is a machine gun. And this so often happens that we're so much in the trenches. We're so busy. We're so stuck in the ways, swords is what we use around here, that actually the solution, i.e. a machine gun, can just be there. And yeah, it can be really difficult, but sometimes you got to make time and space to actually unpack this stuff.
It's so true. And this manifests in so many ways. So busy doing, we don't build the things that will help us actually do better.
All right, what was the advice from Adrian about tactical versus strategic?
So yeah, short-term tactical activity has to align with the long-term strategic. And so, and this is the dilemma of a founder. There's short-term opportunities, like short-term revenue gain, short-term this, but often they're distractionary. And so the lens, there has to be a filter question there of, does this take me towards the strategic vision? And if not, we have to say no.
My mind went off to all the things I've got to say no to. So this came from, I saw posted by the Contrarians podcast with Adam and Adir. And they just point out that a lot of talk is around houses being driven by a housing shortage, which is technically true, but actually houses get bought with this thing called money. And so when you plot the Australian mean dwelling price, and then you plot Australia's money supply, the M3 money supply, and I went and had a look at the M2 as well. It's the same. It's a strong correlation. At the end of the day, availability of credit, availability of money, money supply drives assets. It's then not helped by things like supply and all of those things. So if we start to see that money supply dip, then get ready for maybe a bit of softening. But until then, she just keeps going up. People like Jack pushing up prices. Ash, I think Ash. And this is a chart for listeners at home. So just so we're aware, from 2015, the money supply was 1.8 thousand, whatever that is. I think that's 1.8 trillion. And it's now 3. So there's a shift. And the mean dwelling price has gone from like 600,000 to just under 1 million. So you can just see how that's pushed. The best time to buy a place was 20 years ago, and the second best time is now. And here's the thing with a capitalistic system, in property, not venture, in property, time heals all wounds. In venture, it's the total opposite. But with property, yes, inflation is a bit of a killer, but on a nominal basis, it always comes back. Forward-looking statements always is not defined as always for the purposes of this podcast, if our AFSL is listening. So this is a chart of the MSCI Global Equities Index. So this just takes all of the global indexes and then also plots the percentage of central banks that are cutting interest rates and raising interest rates. And whilst it's not a perfect correlation, you can just see that when central banks start cutting interest rates together, there's a little bit of a lag in some instances, but it certainly pushes stock markets up. And so what's interesting, we already started to see that, but we're not anywhere near the peak of central banks cutting. And so it's going to be interesting to see what global stock markets do. But at the moment, they continue to be we do live in an exponential world. I do believe that a lot of people that mainly are in the older generation thinking back to a lot of booms and busts, I just think we have less of those going forward. Now, one of my favorite entrepreneurs, this is a chart of Starlink customer growth. And I'm currently coming to you today via Starlink.
I was going to say that there's a correlation between Don's positive comments on Musk and how much he needs to use and rely on Starlink.
He's been good lately.
He has.
I had to
Starlink.
I had to clarify for someone the other day. I don't think Elon Musk is a fraud. I think Elon Musk commits fraud holistically. He can't be a fraud because he does deliver and has delivered a whole lot of fantastic outcomes. So there's a nuance there that you can say that somebody delivers some fantastic outcomes while still looking at and seeking to prosecute some of the flaws. So just to clarify that, seeing as I haven't ranted about the big man in a while. But yeah, this is Starlink going back from its launch in 2020, and it's just a J-curve up and to the right, and there's now 4 million Starlink customers. And I'm on my second Starlink, because then I'm about to do my third, because like 3 weeks after I bought the second generation, the pricks came out with like a half the size one again that's perfect for camping. Fuck that guy.
Look at the growth in 6 months. In 6 months, they've gone from, 2.6 million to 4 million users. Far out.
So if you're wondering what product market fit looks like, you found it. Oh, that's not a bad definition, actually. If somebody detests you to their very being and core, but will still use your product, that is some pretty sweet product market fit. So reality, this is a picture of a slightly balding male. The reality on the left is unemployed, but on LinkedIn, what it might say is AI enthusiast, Gen AI evangelist, influencer, inspirer, coach, mentor, project manager, CXO, LinkedIn top voice.
It's missing one done. It's missing thought leader.
Thought leader.
Holy wow.
Yeah. So
this is so true. Like, it cracks me up.
The amount of noise on LinkedIn from this, a little philosophical. There's a tap at the top pouring into a bucket, and all the water pouring in is talent via the tap, but there's all these holes in it, and they're the bad habits. They're the unhealthy habits of all of the talent and opportunity leaking out. And I think that's true. I think most people get their fair share of fill of opportunities, but it's a bit hard to see them when it's leaking like a sieve.
That's a good one.
Now, Jack, you won't understand this one because you haven't seen these movies, but so there's 4 pictures. Well, there's 5, but the 4 is like, and what it's showing is like the worst monsters in movie history. And so you got Hannibal Lecter, you've got Freddy Krueger, you've got that weird clown, like you just got, but actually the biggest monster was Jenny from Forrest Gump.
Over my head, Don.
Grass. Thank you.
All right, you both have to watch Forrest Gump.
I was expecting Donald Trump, that's where my brain went.
No, sadly, Donald Trump is factual, not fiction.
And then, so this is the other Jack in my life, my son Jack. He's just been really naughty at bedtime. And last night I said, I do not want to see your feet leave the bedroom. Where Livy and I are watching TV and then we go to bed. This is him lying, what looks like dead, but he's alive, falling asleep. But he's just lying in the hallway with his torso in the hallway and his feet in his bedroom.
Was he asleep like that?
Yeah, no, like dead to the world asleep, like asleep.
That is so good.
Scared the shit out of me when I saw it because it was just like, what the? So anyway, look, he did what he was asked.
I love that.
So a few random ones in there. It'll be better next week.
What are we looking forward to this weekend, guys?
Long weekend.
Oh, now that we found us long weekend.
We know. Looking forward to it.
Oh, the wedding. I'm looking forward to that. I'll be able to, it's quite a, it'll be great to host them.
I have not thought past today, so I'm just looking forward to going down the Gold Coast tomorrow and catching up with a couple of our investors.
Yeah, I'm in the same boat, Aaron. Yeah, I wish I'd known it was a long weekend. So I could have done something, but yeah.
Well, mate, you've got time. It's only Wednesday.
Yeah.
Also, post rugby, do you actually do anything?
Not really, no.
Yeah.
Grand finals, I'll be watching that Sunday, is it? I don't know, one of them.
And to close the loop, last week I actually was able to stop in and see Aaron at Palm Cove.
Yeah.
Which lasted about 4 minutes because then he went, oh, fuck, I've got to be on a pitch call. So I drove 2.5 hours to see him. Anyway, we gave each other a hug and it was delightful.
Well, it was good you got to catch up with Maren at least.
Yeah, no, that was actually really good. It was good to have a chat.
Yeah. I appreciate you coming to visit.
Oh, it was good. And then my flight got 2 hours delayed anyway.
That's
So
not
that was all good. Well, yeah, and then we have some more Squizify stuff and all the rest. And it's the quarterly update start. And so I just want to make a public declaration to my team, because as the person that predominantly does the portfolio support, it does come with some responsibilities. And that responsibilities is providing the content for the updates. And I can be a terror. And I want to say that I've seen a Buddhist about it and we've worked through it. And this month is going to be different by using ChatGPT and a few other tools. So I'm just publicly putting that out there.
I appreciate it.
I think we'll have to close the loop on this.
Yeah. I don't want, no, don't, please. Yeah. I'm not asking for your belief in said statement. I'm just making the statement.
Well, we'll close the loop with listeners in 3 months' time.
Again, on 360 review done, coming your way.
Yeah. Well, yeah. So we said the same things this quarter as we did last quarter, and we were ignored again. So I'm joking. I'm joking. I wish. All right.
Thanks, Brew.
All right,
See you, team.
see ya.
Bye.
There's.